So for those of you who haven't met me, I'm Cameron Blackwell. I'm one of the financial advisors here at Wilson Pateras. And today we're going to do a presentation presented by Brad Matthews, who is an investment consultant who we use the services of regularly. So we catch up with Brad every quarter, and he gives us very valuable insight into markets, fund managers. So Brad gets to meet up with fund managers on a regular basis who are actually making the tricky decisions on which companies to invest in. So he gets their insight, and then he's able to put that together into digestible pieces for us to understand. So that's really valuable. So hopefully you'll get a bit out of that today from Brad, and then I'll talk just briefly about using sort of Brad's expertise and the other resources we have, how we then put together our portfolios for our clients. So we can spend a bit of time on that as well. As we go through the prezzo, you might have questions for Brad or myself, so that's fine. There is the ability to do that in the forum. So there's a chat box you should be able to see at the bottom. There's also a Q&A function as well, so you can probably use either of those. We should be able to pick them up as we move along, and if there's lots of questions, we might use a few of them through the presentation. Otherwise we might save them for the end and get Brad to have a look at them at the finish if we have time. Okay, so I'll just kick things off. As always, there's a general advice warning for these sorts of presentations, so any advice in the presentation is just general in nature. Now, this is a financial planning team, or at least there's four of us. That's a great photo. The financial planning team, it's part of the Wilson Pateras organisation. We're now 12 staff strong. It's been around for many years, the financial planning division, but probably expanded a bit more over the last sort of 2 or 3 years. So we are a reasonable sized team now, able to provide holistic advice for our Wilson Pateras clients. That's what we do. So this is a bit of a summary of the things that we do as the financial planning team. Just a very high level there, but it is really holistic. So it's pretty much everything with respect to our clients' objectives at any sort of age. They can be accumulators, they can be retirees, they can be any manner of sort of clientele and needs depending on where they're at. So you can see a few of the things there that we look at in particular. And so we work closely with the accounting side of the business as well. So there's quite a bit of crossover between accounting clients that move over to financial planning, and they get sort of to leverage off that the services that we provide as a whole. So that's a bit about what the financial planning people or team does. To contact us with any sort of questions regarding financial planning, if you've got an accountant, you can definitely go through them, or you can contact myself or Christine Mitzi. So I might provide those contact details at the very end of the presentation if you've got questions to come back to us directly after the presentation if we don't cover it off during the presentation. Now, before I hand over to Brad, I just wanted to talk about something that's been completely front and center for the last couple of weeks, certainly at my house, is the Olympics. It's the one time that we've had the TV basically on all the time. We've got one TV in our house, and normally it's only on for a little bit with my 2 young daughters, but they got full carte blanche over the last 2 weeks. So it was always there available to them. The problem we had was there were so many sports now. I think from back when I was a child watching the Olympics, it would pretty much just be either swimming or athletics. That was pretty much all you got to watch. But now we have all the channels on 9, and there's 30 or so sports to watch. So the difficulty we had as a family was which sport to watch. I preferred the basketball. My 10-year-old daughter loved the high jump for some reason, even though she doesn't do that, but she really enjoyed that. My 8-year-old loved the wrestling. Again, I have no idea why she enjoys wrestling, so we had to watch that. And then my wife, her favorite was the men's diving. Surprise, surprise. So they were the 4 sports that we mostly watched. But it made me think, now that it's finished, the Olympics, I just brought a few numbers up that were just sort of interesting to me on the back of the Olympics. So 500,000, what is that? That is what Snoop Dogg, the rapper, was paid daily for his role as the special correspondent for the NBC, which didn't include his expenses, which goodness knows what they would have cost. So it works out to be a whopping $9.5 million for Snoop's contribution to the NBC coverage, which sounds like a lot of money, but when you think about how much they've paid for the rights to 2032 is $7.75 billion they've paid the IOC, then Snoop Dogg's payment seems fairly insignificant. 768,000. I just thought this was interesting because it just shows the, Olympics started as it's essentially it's not a professional sport. You don't get paid for it, but it just shows that the countries that do well are often the ones that are able to, fund their sports people's development, etc. So this just showed the people that actually do well and get a medal at the Olympics, how much they get paid by their country. So Hong Kong was at the top of that list. So those two fences you see there, each received $768,000 for winning gold. So that was pretty exceptional. And Australia's pretty low on that list in the table there. And then just finally, I just thought, sort of the elephant in the room, these massive events, what is the impact to the environment? It's obviously not small. 1.58 million metric tons of carbon dioxide released into the atmosphere, estimated from the games in Paris. To put that in perspective there, that was the same warming impact as driving 376,000 cars for 1 year, or 9.48 million trees, the amount of carbon dioxide that they could store for 1 year. But it was less than generated by some margin than London and Rio. So I guess that's some positive to take from that. Okay, anyway, that's enough of that. I'll hand it over to Brad. So just in summary, Brad Matthews, investment consultant, founder of his firm, an investment consultancy firm, works closely with us as part of the investment committee for Wilson Pateras. Okay, so I'll hand over to you, Brad. You can just let me know if you need any help.
Okay, thanks, Cameron. That was interesting, and I certainly missed the Olympics last night, but I suspect Channel 9 will do pretty well out of having the block run straight after that. So they saturated the advertising with that. So good luck to them. But moving on to the economy, and I'll focus initially on the economy and then talk about some of the implications for financial markets towards the end of the material here, but won't take too long to move through this, because economics can get a bit dull for some people. So we'll try and keep this as short and sharp as possible. In terms of where we're up to from the Australian economy perspective, it's actually quite a bit different to where the US economy is at, and that's made interpreting the outlook and trends on financial markets quite difficult, given the disparity that's sort of emerging between the largest economy in the world and much of the global economy as a result, and where we are in Australia. In terms of where we are in Australia, we're in a pretty flat spot when it comes to economic growth. The rate of expansion in the year to March, which is the latest economic growth data we have, so how much the Australian economy is expanding, was only 1.1%. So that's well below the long-term average growth rate. After you take out inflation from those numbers, the long-term growth rate is about 3%. What makes those numbers worse is the fact that population growth in Australia, as no doubt you've been hearing through the media reports, is actually very strong at the moment. The annual rate of population growth is 2.4%. So we've actually been going backwards in terms of what the Australian economy is producing per person, which isn't a great thing. Ultimately, our living standards are determined by what the economy produces, and that's been negative for each of the past 5 quarters now. So a reasonably recessed state is technically not a recession, because recessions don't take into consideration the population growth, but things are pretty flat. There hasn't been a lot of growth in recent times in the Australian economy. let's move on to the next one, Cameron.
Yep.
One of the things that has been driving that is the fact that consumer spending by households has dropped quite materially. We did have a big boost to consumption spending in that immediate post-COVID period, and that was partly due to the fact that we'd had accumulated a large pool of savings through the COVID period, and certainly that was assisted by government payments to households. That pool of savings has pretty much now been run down, and there is it's been termed a cost of living crisis, but certainly households are feeling the pinch in terms of the gap between what they're earning and what they're able to spend. The chart on the left-hand side there tries to show the change in real household disposable income. So this is after you adjust for inflation, how much money do households have available to spend? And that's shown in the black line there. And you can see that that's quite negative for the majority of the past 3 years. We've actually moved into negative growth in disposable income. Now, what the graph is quite complex. The different coloured bars show you the different components of that. So what's been pushing household disposable income into the negative are the purple component of that bar, which is inflation, the green part, which is tax. So we've actually had reasonably significant increases in tax purely because the tax scales up until the 1st of July haven't changed. As wages have been increasing, there's been a higher average rate of taxation paid, which possibly isn't a surprise to a lot of people. The other component, which has been in the media as well, has been the rise in interest rates, and the repayment of interest on loans has also cut into household spending. So we've had that negative movement in disposable income, which has flowed through to very depressed consumer spending, which is one of the reasons why we have such flat economic growth here in Australia at the moment. In contrast, one area that has been holding the economy up has been government spending. The chart on the screen there shows government spending as a percentage of GDP, or the total production in the economy. And it was well known at the time that through the COVID crisis, which commenced early in 2020, you can see the extent of the rise of government spending compared to the size of the economy was quite a sharp increase. What's possibly more surprising, though, is that we haven't actually seen that government spending come back down to the levels that it was pre-COVID. It's remained very elevated. So what's been happening there is that whilst the government budget position has been quite neutral in terms of it, we're actually running a slight surplus in terms of the Commonwealth government budget at the moment. We have actually had a big increase in taxation, not just from the domestic sources, but probably more importantly as a result of quite strong commodity prices, iron ore prices in particular, which has driven a lot of government corporate tax revenue. And that corporate tax revenue has been recycled through the economy through higher government spending. So that's been one source of stimulus for the Australian economy, has been that factor, higher government spending, which has been made possible largely through higher earnings on tax, and in particular the tax that we get through the mining companies on the iron ore price. However, when we look at this chart, which shows the movement in the iron ore price over the last 12 months, we can see that the iron ore price did peak at the end of 2023, and since the start of 2024, it has actually been declining, and that decline has been reasonably significant. One of the big consumers of iron ore is China, and that economy has been relatively modest in terms of its growth, and certainly not going through the same level of construction or infrastructure expansion that we've been used to over the last couple of decades, which really did drive a lot of the iron ore demand. And has been one of the reasons why the Australian economy has done so well over the last couple of decades. So that's started to turn around, and it's only quite recently that we've seen that play out in terms of the iron ore price coming down. It did defy gravity through 2023 when the Chinese economy was still pretty recessed, and we saw growth in the iron ore price, which did surprise a lot of people. But it has ultimately behaved more in line with expectations and has come down. And that will have implications for the Australian economy, and in particular, government revenue moving forward. So the government won't have the luxury over the next couple of years to raise spending to offset any weakness that we've got in the private sector at the moment. Another area of concern for the Australian economy has been productivity. So productivity, there's different ways of measuring it, but generally the way we measure productivity is really the efficiency of labour. So we take the overall production in the economy and divide by the number of hours worked. And on that measure, we've actually never done as poorly as we have over the last couple of years. It's quite a depressing chart, this one, because it's ultimately productivity which drives our living standards. How much can we produce per person or per hour that's worked? So there has been quite a sharp decline there in productivity, which is another reason why our economic growth hasn't been very strong. It's probably not as bad as it appears, but it's still a constraint on the economy. So whilst employment growth has been strong, we haven't actually seen the output from that employment rise as much as we would have expected. So we just haven't seen the reforms or the productivity improvements in industry and in government to get the same return out of working hours that we would have in previous periods when productivity has generally gone up fairly steadily over past decades. I'll just move on to the next chart, which shows an interesting change in workforce participation in Australia. So one of the reasons that productivity has gone down is because we've actually had quite a strong growth in working hours, and this has occurred since the COVID period, and it's been quite unique to Australia and New Zealand, where the chart shows the percent of the adult population that is employed. So we've actually had quite a significant increase since COVID, as has New Zealand. Whereas if we look at the United States, all economies did take a big hit in the employment to population ratio through COVID, but the United States and the UK didn't get back to the levels that they were used to prior to COVID, where we've sort of overshot those levels quite comfortably. So it's a little bit curious as to why that is the case, but it's part of the reason why our productivity numbers have been so challenging, because we have had this big increase in employment. I do suspect there's possibly some definitional issues here, in that there was perhaps a lot more workers in the cash economy prior to COVID, and COVID really forced a lot of businesses to put everything through the books. So possibly our employment numbers aren't quite as strong as the data suggests, and that may help explain why that productivity number is on face value quite weak. But I guess the good news from this chart is that our employment market has generally been pretty strong, and part of that has been due to that government component, where we've had a lot of growth in healthcare and NDIS related activities, which has helped support the economy and helped support the employment market. Some better news, I guess, on the inflation front. So one of the reasons that we have had that increase in interest rates, which I touched on earlier, was to try and bring about a lower level of inflation. Inflation surged in that post-COVID period, partly due to the strong demand that was built up, pent up, at a time when production really stopped through COVID. So not surprisingly that we did have that big spurt of inflation, and central banks right around the world were forced all to do the same thing to try and bring that inflation back under control by raising interest rates. And we have seen inflation come down off its peak of around 7.7 down to 3.8 at the moment. The concerning thing for Australia is that downward movement in the line there, you can see, has sort of paused for the time being in 2024. Whereas other economies such as the US, you've actually seen a steadier decline in inflation. So there's a little bit of concern that our inflation decline hasn't kept going. The long-term target for inflation is between 2 and 3%. So we're still sitting above that. And that's why the Reserve Bank has been a little bit tempted. You may have seen some of the commentary come out of their discussions that perhaps another increase is warranted. that's probably off the table for the time being, but it does suggest that there maybe isn't scope for those interest rates to come down in the near term until we actually bring that inflation back into line with the long-term target. Other areas of good news that are touched on in the chart there is, I've mentioned unemployment does remain pretty low. That's ultimately good for society, but also good for the economy if people are working, producing output. Business profitability is still very healthy. There's actually very few corporate bankruptcies outside of a few specific sectors, such as property development at the moment. And the numbers tend to be more at the smaller end of the scale in terms of business size. The other positive is that the global economy itself is pretty stable. Growth is moderate, but positive, and that also helps from an Australian perspective in supporting our overall export volumes and income.
So, Brad, do you see any reason that the CPI would increase from here, or is it more likely to trend downwards?
Yeah, look, I think it's still on a downward trajectory. The part of the CPI that's proving quite stubborn is the services area. Things like housing rents, insurance have been very, very sticky, whereas a lot of the goods components have actually continued on that downward trajectory. So I do think because the economy is soft and consumer demand is quite soft, that you will actually see further declines in inflation. But it's just taking longer than many would have expected, and is causing a little bit of concern. I did mention that the global economy is faring better than the Australian economy is more broadly, and the one economy that's probably doing the best amongst the majors is the US. And that's important because it is the biggest economy. It has the most impact on the global economy. This chart's quite interesting. It just shows the change in per person household consumption, and it's the opposite to Australia, where you've had over 2% growth in consumption spending by households in the US, and part of that is because of the structure of interest rates is quite different in the US, where the vast majority of their mortgage lending is done on a fixed rate basis. So raising interest rates doesn't have an immediate effect in the same way that it does in some other economies. And Australia very much has a variable interest rate structure. So an interest rate rise here has a more immediate effect on spending. And that's part of the reason why the US cash rate has been able to be increased further. They're up at around 5.3%. Whereas our cash rate's at 4.35, but it's actually had a bigger impact on our economy than the increase in the US has had. So that's quite an interesting comparison there. Other parts of the globe aren't quite as strong. I mean, Europe and Japan are not in recession, but are running at fairly modest rates of growth at the moment. The positive or promising aspect to the US economy as well is that because they have had that success on inflation, that there's a very strong consensus their interest rates will start to fall from September this year, which may give their economy another injection of stimulus, which will keep it well away from a recessionary scenario.
And Brad, can you just talk about Japan a little bit here, just with their rates and their movements over the last couple of weeks and the impact on sort of the broader markets?
Yeah, for sure. Yeah, so the Japanese economy is very different to most other economies in that they've had a prolonged period of exceptionally low interest rates. So really their cash rate's been at zero or negative at times for the majority of the past couple of decades. And for various reasons, partly one is the fact that the Japanese population is in a negative trend. They're actually shrinking in terms of an overall size of their population. They've had very little inflationary pressures despite having such loose monetary policy and such low interest rates. What was happening over the last 6 to 9 months was that because all the other economies that increased interest rates so materially over the last couple of years, the value of the yen was depreciating. Investors didn't want to hold yen because it wasn't returning anything in terms of interest rates. So ultimately, that forced the Bank of Japan to tighten policy, and they announced at the end of July that the cash rate was going from sort of near zero up to 0.25, and that they would be less supportive about buying Japanese government bonds, which meant that longer-term bond yields also increased. So that seems to be one of the triggers for the correction that we had on equity markets last week, was that rise in interest rates in Japan meant that some investors, and this was a very common strategy by investments and investment funds, where they would borrow in Japan at very low interest rates and invest in global share markets and the Japanese share market as well. And when you're not being charged an interest rate on your borrowings, then the margin that you can earn on that is quite healthy. So some of that trade was starting to be unwound because of the increase in interest rates in Japan, which was thought to be one of the triggers for the correction that we had on equity markets. That's certainly settled down, but that initial impact did seem to have ramifications across financial markets.
Right.
Also touching on the global economy, as said, the US economy is travelling along pretty well still. The other area that does spark our interest from an investment perspective are the emerging economies. So these are the less developed economies, including China, Korea, and Taiwan. Debatable whether they should be classified as emerging, but they are in the way. The global equity indexes are split. But large parts of Asia, South America, these areas typically run at higher economic growth rates and provide the promise of relatively high earnings growth for the companies that are domiciled there. And what we've seen play out on equity markets over the past few years is that we've had much stronger growth in developed markets, and particularly the US market, and that's left behind the emerging markets, which from a valuation perspective do look attractive. The chart shows the what we call the price to book multiple, so the relationship between share prices and the value of a company based on its accounting values. You can see how that's that margin between the developed markets in the blue line and emerging markets in the orange, how that's widened, and it is very much at a cyclical high in terms of that gap. So we do see a bit of an opportunity in emerging markets. The majority of them are running with quite low government deficits, tend to be doing pretty well on their trade accounts as well. So some of the areas of instability in emerging economies that's characterised a lot of Latin America, for example, over the last 20 or 30 years. There's not too many of those situations at the moment. So we're quite positively disposed to emerging markets from a share market perspective. It also helps diversify portfolios against developed markets, which have been increasingly dominated by the US. The US market's just got bigger and bigger as a share of the total. So it's important to look for other sources of diversification at the moment.
Right. Next slide.
Just sort of summing up in terms of the overall implications for financial markets, the table there shows the returns through the main asset classes, and it's probably worth noting this is up to the end of July, so before we had that correction last week. But it has been a pretty strong period when you look at those annual numbers and the 3-year numbers for Australian equities and global equities. Global equities in particular, up 22% for the 12 months to July. That's a very strong result, around 3 times the longer term average. So we tend to model our returns, expect to get around 7.5% per annum out of equity markets. So it's been an unusually strong period, and part of that has been driven by the tech companies in the US and the benefit that they're getting from the developments around artificial intelligence. That's been a big thematic on markets over the past couple of years. So that those returns can't continue indefinitely. but it has been a good period for equity market investors. A little bit more moderate around the real assets, so property and infrastructure. You can see there for the year, global listed property up 7, global infrastructure up 9. Still very good results, but not quite at the same pace as equities. Australian listed property, interestingly, up 27. The majority of that is due to the Goodman Group, which now makes up around 30% of, I think might be even 35% of Australian listed property. Now, Goodman's done a lot of development around data centres, and that's also captured that technology theme through artificial intelligence as well. So that's been the main driver there. And the fixed interest returns, investing in the bond markets, have delivered returns slightly above cash rates, which is in the long term what you would expect to get out of investing at the longer end of the yield curve. So that's all been quite positive. Moving forward, sort of based on the comments around the Australian economy, it's difficult to see that there's going to be huge earnings growth for Australian companies. There's not a lot of asset growth for the banking sector at the moment, and resource stocks are somewhat hamstrung by weaker commodity prices. So it could be quite a challenging period for Australian companies in the year ahead. There's still good momentum in global equities in terms of earnings numbers. A lot of it is built into expectations now because we have had such a strong period. The next 6 months might be a bit challenging. We do have the uncertainty of the US election and some geopolitical factors that are largely unresolved could weigh on sentiment. But underlying fundamental company earnings in terms of global equities still do look pretty promising. Real assets, so property and infrastructure, relatively well positioned because they haven't had that run up in capital values over the last few years. They're not overly expensive, and particularly if we do see interest rates come down, then that could be a positive tailwind for property and infrastructure at the global level, as it would be for bonds within fixed interest portfolios as well. So I wouldn't be overly excited about equities. Certainly not. There's nothing broken. There's no dysfunction in markets, so not necessarily time to go and sell equities. But I think given the performance that we've had over the past few years, we need to be a little bit more realistic about what we can expect over the next couple from share markets.
So, Brad, I've got a question here from one of the attendees relating to the the US election. So if Trump wins the US election and initiates high import tariffs on goods imported by US, what effect would that have for Australia and more globally?
Yeah, look, it's hard to say to what extent there will be further tariffs, and the current administration has been sort of in recent times fairly active in increasing tariffs on Chinese imports in particular. But generally, an increase in tariffs is negative for nearly everyone other than the US in terms of their immediate effect. So it potentially puts more pressure on the trade accounts. I think if there is further increase in tariffs in the US, you would expect that they're going to be increasingly skewed to China. So I don't think Australia is necessarily in the direct firing line there, but a broad-based rise in tariffs would be negative for the Australian economy, and I think ultimately negative for the US economy. There's possibly short-term benefits and short-term winners within the corporate sector, but it's largely a negative all round. And I think economic theory demonstrates, and I think we've been the beneficiaries of up until the last sort of 5 to 6 years. A few decades of a very strong trend towards more global free trade, and I think that's well documented in terms of some of the benefits of that. So if there is a further erosion of free trade through increased protection, I ultimately think it's a negative factor all around.
Yep. And just on the US election, so a Trump loss, is that more detrimental for markets? Like, was it priced in that he wins, or is it sort of an even bet now?
Yeah, look, I think it's possibly one of the underlying factors behind the correction that we had last week was that investors have become a bit more nervous. I think that rightly or wrongly, a Republican victory was seen as being pro business profitability, and that was a very strong consensus that you would have a Republican victory. With the change in leadership of the Democrats, that is now looking more of a 50-50 bet. So I think if there is a Democratic victory, it may have some shorter term negative implications for markets at least. I don't know that there's actually too much difference in policy though. It's difficult to see where the actual policy differences lie and how that will play out. But I think just general sentiment may take a bit of a hit if there is a Democrat victory. But I think possibly the market's building some of that into expectations now.
Yeah.
With the hit that we took. Might just move on to the next chart because it does actually show what happened last week. So with those numbers on the table, it's the end of July. This chart shows where markets got to at the end of last week after the correction. The blue line is the global index, and the red line is the Australian ASX 200. Shows what happened over the last 12 months, and you can see the correction was taking about 6%, a little bit more off the growth that we've had, but still well ahead on an annual basis. But I do think the Japanese interest rate rise was significant as a factor there. Uncertainty over the US election was probably an underlying factor. There was one piece of economic data in the US that was weaker than expected. The employment numbers came out, and there was some narrative around a higher chance of recession in the US. I think that's really overstating one piece of data in terms of I think the majority of data in the US is still quite supportive of positive economic growth. And I think interestingly, we have seen markets bounce back pretty quickly and stabilise quite well over the past couple of days. In terms of some of the risks, apart from the normal risks around market movements, a few areas I think deserve particular focus for risk management at the moment. The first one is property and property-related activities. We have seen a big decline in the valuations of office buildings, and whilst that sort of played out over a reasonably long period in the post-COVID era, perhaps it hasn't fully washed through the system as yet. So investments and investment products that are lending to commercial property owners is an area of additional risk at the moment. And property development more generally in any period of high interest rates tends to come under pressure. And as I mentioned earlier, that's probably in Australia in particular, that's an area where we have had a big spike in bankruptcies. So that's an area of caution for us at the moment. I have mentioned the US technology sector and the growth in the US as in its share of overall global equities. In addition to the big allocations that most investment funds now have to the US technology sector, we also have big exposures to the US dollar as a direct result of that. So looking at ways that we can potentially diversify against that US dollar exposure in portfolios is becoming more important. Locally, we have seen big growth in private debt, and private debt is where groups other than the banks are lending money to corporates, and even in the housing market, we've seen a big increase in non-bank lending, and those non-bank lenders then have to raise money. So there's a lot of investment products that have been created to fund that lending, and we do see some liquidity risks in that space for investors. Again, it's an area we want to be quite cautious. The last point there is less a risk in terms of the safety of an investment or prudential risk, but we are seeing a number of fund managers come under cost pressure, and ultimately that may affect their ability to outperform indexes. So we rely on our fund managers not only to manage risk but also to ultimately return better than the benchmark. and they need to invest and have money available to invest in processes and resources and so on. And it's a very difficult environment for fund managers at the moment. They're competing against large passive funds and ETFs, and getting a smaller and smaller share of the market as a result. So we're just conscious that their ability to invest in their processes and their staff is a bit less than it has been in the past in a number of cases, not all cases. And something we're having a look at when we select and look at fund managers to be included in portfolios. So that's, I think, brought me to the end of my part of the presentation, Cameron. So,
Nice one. Thanks, Brad. I'll get you to stay on the line. There's a couple of questions, but I might just leave them for the end. I'll just run through my little piece first, and then we might just circle back, Brad, and get some final Q&A at the end of the presentation, which I think we have about 15 minutes to go. So that should give us plenty of time. I'm just going to talk a little bit about how we, sort of armed with Brad's insight and other research that we obtained, how we then put together portfolios for our clients. So the starting point always when we're talking about putting together a portfolio is identifying our clients' appetite for risk, and that helps us determine their risk profile. So how we determine that is based on clients' personal experience with investing. Are they worried about investment volatility? Are they not? What is their time frame? What are they going to use the investment for? Is it a long-term investment, i.e. retirement planning? Is it a more short-term focus? And all these things help us determine how best we should invest those monies with respect to an asset allocation that is appropriate, because the higher exposure to growth assets that can generate, higher level of earnings, but not without risk and volatility. So that's the ups and downs of the portfolio. So we're trying to achieve essentially a return that's suitable for our clients at a suitable or appropriate level of risk to achieve that. And that's where the strategic asset allocation comes in. So that table there is from our risk profile questionnaire, which sort of talks a bit about each of the sort of broad risk profiles. That's the columns above. So, 70% to growth assets for one. The asset allocation that we adopt for that risk profile is laid out there. And then it gives some ideas about what the expected returns are and the volatility for that portfolio for 70%, with sort of long term, it's around 6.26%. It's been higher than that in the past, but has come off a little bit over the last 2 or 3 years. But that's sort of broadly what we're expecting with our portfolios. Let me just step through. So why is diversification important? Obviously, it's well talked about, diversification. Financial advisors talk about it all the time. It is purely because we don't know which asset class is going to do best or worst at any one particular time. And so we're trying to put together a blended portfolio of each asset class to sort of achieve that risk-weighted return that is suitable for clients. So this table provides a bit of insight as to what that looks like from an asset class perspective. So if you just focused on the Australian equities, which is the yellow squares, in any given year, they may do particularly well. So I guess post GFC, 2012, Australian equities had returned 20%, but then only 2 years later, that 12-month period, they were 5.6%. So it's not as simple as just buying an Australian equities portfolio and holding on to that into perpetuity. We're trying to achieve a return that's going to sort of hold up year on year, and that's where the asset allocation process is important. So that's part of the process of sort of putting together the portfolio. Then we've got to actually select the investments that go into the portfolio. So we do that. Really, our starting point is we sort of try to draw a ring around a large group of funds or ETFs that are well researched. So we have research that we get from Lonsec, Bell Potter, from BMI, which is Brad's company. So we sort of use that research to put together a large list of securities that we can then utilize to sort of build the portfolio. So the reason we have so many products on there's 290 managed funds, which does seem like a lot, but obviously we don't use all of those in any one time. But it provides us with a really comfortable level of securities that we can put together for any sort of portfolio size or shape. So, and clients' objectives. So there's a few examples there. Passive and active strategies. I'll talk about a bit more about that later on. Style factors. So in the Australian equities, you might have different sort of mandates that the Australian equities fund manager will adopt. And so we can use complementary styles in terms of the Australian equities, but also cost is important and size of the particular fund. So we're trying to build together a large group of securities that we can choose from. We do go beyond the APL though. It's not as if we have to use that at all times. So for clients' needs are such that we need to go outside of the APL, we certainly do that on a case-by-case basis. So that's the APL. Then the types of portfolios, we have a few different types. The main one, this is probably the traditional approach, is a single sector portfolio whereby we put together a portfolio similar to the table there on the right, built on single sector funds, right? So we're trying to choose ETFs or funds, managed funds in each asset class and put them together in a way that provides complementary styles, active, passive approach based on the strategic asset allocation. And that's our real starting point for a portfolio. And then we would rebalance that portfolio over time back to the asset allocation to sort of achieve the optimal risk-rated returns over time. So that is a traditional approach. The number of funds in that portfolio can vary. It's sort of 10 to 20 securities on. Typically, this one there has about 15 funds in it. That's sort of a typical size portfolio. So you want to have enough funds in there to provide sort of manager diversification. But you don't necessarily want the portfolio to be too large because that can increase potential transaction costs in the portfolio as well, and probably reduces the management diversification at any rate. So it is a function a bit of the actual quantum of the portfolio, or in dollar terms, as to how many securities we might get into there. That's a single sector portfolio. You can simplify it more though. So a diversified fund or multi-manager approach is another portfolio that we utilize for some clients, and that can be sort of a less sophisticated, I suppose, portfolio in the sense that it's one fund, or in the case of a multi-manager, it's sort of one fund which actually has several funds underlying that they sort of report to the fund manager. And this is a simpler approach. The rebalancing of the portfolio is done by the fund manager, and therefore not by us or by our clients. So it's a simpler strategy, which can suit some clients. As a result, typically a diversified fund can be a bit more expensive in the investment fee compared to, say, the single sector portfolios that we put together, which sort of have an active and a passive overlay, and the passive investment approach is a bit cheaper. So that can be an additional cost for the diversified fund, although you can have a passive diversified fund, which is a lower cost strategy overall. So they're sort of the two sort of different main types of portfolios that we put together. There's sort of variations on a theme on this slide here, where core and satellite is probably the main one, where you have a core diversified fund, which is typically a passive fund, and then you might have some single sector fund managers as sort of trying to provide some outperformance around that core. The satellite funds, that's one approach. I mentioned the other two there. So managed discretionary account is a very bespoke portfolio strategy, whereby we're actually employing a fund manager to manage a total portfolio. Inside that portfolio, there could be single sector, active, passive, everything, but they actually manage that portfolio in a discretionary way. So it's done sort of automatically. And they have control over the asset allocation strategy and everything. So that is a very bespoke strategy, which is appropriate for some of our clients. And the separately managed account is a sort of a smaller it's normally just one asset class. So you might have an Australian equities SMA, which is similar to a managed fund, except you'll actually see the underlying securities inside that fund. So it's probably suitable for clients who are a bit more engaged in the investment process and like to know where their monies are being invested. Just a few other points here that we consider as part of our portfolio management for our clients. So currency hedging, which Brad sort of touched on through the presentation. So we'll sort of have a neutral hedging strategy for our portfolios, which is typically around 60% unhedged, 40% hedged, but it can vary. And it can vary depending on, what the relative currencies are doing at any one point in time. So if we have a new client with new money and they're trying to enter into a global equities portfolio, depending on where it's typically the US dollar, A dollar varies at that point in time. So if the Aussie dollar is a long way from its sort of long-term norm, we might sort of vary that hedging strategy at that entry point. Tactical asset allocation is just an expansion on the strategic asset allocation. And although we might take a little bit of a view in each particular asset class based on prevailing market conditions, and we normally seek some guidance from Brad on that space. Normally not a huge overweight or underweight position, but just trying to sort of achieve a little bit of a tactical approach on the asset allocation as we go along. Liquidity is really a focus for any portfolio that we put together, because essentially our portfolios are put together with our clients' objectives in mind. So the liquidity is very important for ensuring that the client's income needs are met. So we always make sure that there's a cash reserve strategy in place before we even sort of get to the asset allocation. It's very important. And active and passive, I'm sure a lot of the viewers on today would understand this idea of active management versus passive. Passive being just tracking a particular index, and that's typically at a lower cost, whereas an active manager is trying to outperform an index or a benchmark over time. And because neither strategy works all the time, we tend to incorporate a blended approach for our portfolios. So that's what we sort of do, and that might vary. It could be between. It's typically maybe 60% active, but it can vary from time to time as well. So that's our position on active and passive. This is another important factor. We have more and more clients sort of wanting to put together a portfolio that meets their sort of environmental ideals, and so it's getting easier for us in the sense that there are more and more funds available to us now that actually have this ethos or mandate approach that we can utilize. So they'll actually have a very strict screening process, screening out different types of fund managers who invest in companies whereby they don't. So if those companies don't have that mandate, they're screened out from the portfolio that the fund manager is creating, and therefore they will be screened out of our portfolios for our clients. So there's more and more options on this front that are available to us, so we can achieve a suitable portfolio with sort of comparable returns to a traditional approach at a similar investment fee as well. So it's becoming more and more common. So that's these funds go onto our APL over time as well as we move forward. So that's our approach on that front. And I guess the final bit is just reviewing the portfolio once it's put in place. I mean, it's one thing to actually determine a suitable portfolio and at a point in time, but things do change. So things can change. The risk profile to our clients might change over time, but that would be more of a function of their needs. Perhaps as the obvious one is move from accumulation phase to retirement. So perhaps that's a de-risking of the portfolio. So that would be an obvious one. But also things that happen at the security level. So we might change funds because of a few of those points there. There could be a key staff, so a key principal at a fund manager leaves the firm. That would be a significant change for that particular fund. So that would give us call to review that fund and potentially take it out of our clients' portfolios. active managers becoming too index-like was another one. The funds becoming too large and therefore less able to move in their particular space in the market. So there's a few things that we would look at for our clients, and for our clients who sort of use our services on an ongoing basis, this is something that we would look at year on year. And we don't turn over portfolios for the sake of it, but it's an important part of the portfolio management over time. And the rebalancing is really the key there to try to achieve a risk-rated return rather than just letting your profits run. And the idea we stick by is trying to sort of take profits from at times, at sort of regular times, and then redeploying those monies into asset classes that are at a better price. And that process over time should achieve a good return with the risk-weighted considerations in mind for our clients. So I think that is my last slide. Now, have I still got you there, Brad? Yes. So I've got one question. So Sash was just asking, in respect to the Aussie market for the next 12 months, which sectors are showing potential for growth in Australia?
Yeah, look, it's a really good question. As I mentioned, not a lot of balance sheet growth for banks. Their lending's not going up significantly, so we're not seeing much expansion in earnings there. Resources under commodity price constraints. Consumer-facing sectors are under constraint from weak household spending. Even though we've actually seen quite strong growth in consumer discretionary stocks in particular over the last 12 months. So I think that removes a lot of the opportunities there. So I think you do have to get down into the mids and small stocks to find good upside, because we have seen mid cap and small cap stocks lag in terms of valuation. So whilst the overall macro conditions may not be overly favourable, I think from a valuation perspective, you'll still have some very good stock-specific stories coming through. And that's where we do rely heavily on fund managers to uncover those opportunities. The one caveat that I would place on that, though, is that if we do get a broader correction in the market, you'll often see your small caps sell down by more than the market average, simply because there's less liquidity there. People are more fearful holding those smaller companies, so they can get knocked around a bit more. But I think from a long-term valuation perspective and a long-term growth opportunity perspective, a bit of a bias to mids and smalls is probably not a bad place to be in the Australian market at the moment.
That's good. I think that answers Sasha's question. Let me just see if there's any more questions here. I think that's covered the ones that have popped up. So I think is that roughly on time? So 3:30.
Right on 2:30. Yeah,
we get 2:30. Perfect. So thank you everyone for joining Brad and myself. I hope you've got something out of today's presentation. Brad, so we have a market overview which we can provide to anyone who is interested in getting some more information in respect to Brad's commentary today. So we can provide that. If you send an email to the info inbox there, Christine or one of the team from our financial planning team will come back to you directly. And yes, if anyone who's a client of Wilson Pateras and wants to know more about the financial planning side, please you go through your accountant, or you can come directly through the financial planning team at the info email address there. And anyone who's not on Wilson Pateras as a client, then that's the same thing as well. So that's fine. Okay, well, thanks everyone for joining. Thank you, Brad, for your presentation today.
Thank you. Thanks for having us.